Hello, my name is Aaron Patrick, and in today's video we're going to talk about what's called the director's loan account or director's current account. We're going to talk about what it means, what to do with it, and also how to avoid any nasty tax along the way. If you own a limited company, then this is a video for you. Stay tuned. Hello, my name is Aaron Patrick. I'm a chartered accountant, certified UK trainer for Intuit QuickBooks, that QuickBooks chap, and the head of accounts here at Boffix. Now, if you've got a limited company, one of the things that you will hear about a lot is your director's loan account. But what is it? Well, effectively, your director's loan account is that whole idea that the limited company is a separate legal entity. So if it's a separate legal entity and there's you, then when you take money from that separate legal entity, you need to be accounting for it in a certain way. And by far the most simplistic way of doing that is to use a director's loan account. Because effectively, you interacting with the world by buying items for the business or being remunerated for the work you've done for the business, you're going to interact with that via your director's loan account. So if the limited company over here is trying to give money to the director, that's a director's loan account transaction. If the director is giving money to the business, then it's a director's loan account transaction. And think about it as like a mini bank account within your limited company. Now, we call it a director's loan account. We use a director's loan account to make things as simple as possible for you as your business. Because ideally, what you want to do is you want to keep an eye on that balance so that then you can interact with it accordingly. And that balance will either be a loan to the company or a loan from the company. So either you as the individual are going to owe money to the company or the company is going to owe money to you. And the simple rule to make sure that you abide by is you always want to, if possible, have the ability that the company owes you money and you don't owe the company. More on that later. Okay, so in principle then, it's a way in which your company owes you money or interacts with you. What sort of transactions would we see in there? Well, if you're going to be paying for things on behalf of the company, so think about the very beginning of the life cycle of a company. At the very beginning, it doesn't have a bank account or cash account or anything like that. So it's going to rely on you to be able to put money in there to start the business up. That's a director's loan transaction. That's increasing the loan that effectively you're owed. If you go and do personal expenditure on behalf of the business, say for example you do mileage and you drive from one area to the next and you claim that 45p, well, if you do that, you have the ability to take the money out. But if you don't take the money out, then instead you can opt for it to go against your director's loan, increasing again the amount of money that that company owes you. And the beauty of it is, if the company owes you money and you take that money out, there's no tax consequences whatsoever. At the end of the day, you've lent the money to the company and then you've taken that money out. So we can see it's a bit like a little mini bank account inside the company. But it also means that every time you take money out, the first step we would always recommend if you're taking money out is to put it against your director's loan account. Because that way, from an administration point of view and simplicity point of view, you can just see the running total of what your director's loan, all the money you've taken out and all the money you've put in. Now, if you're taking a director's salary, you can opt to physically take the money out, or again, you can put it against the director's loan account, increasing that loan account. Because again, you're opting to not take the cash itself, you're putting that cash against your director's loan account. Then, if you take dividends, you can again take the dividends directly out of the bank itself and just pay yourself and declare them as dividends. Or, if the cash isn't readily available in the bank, then why not put it against your director's loan account, knowing that later down the line when there's more cash available, that's when you're going to take the money out, and you then are taking it against your director's loan account. So this director's loan account should always be evolving. There should be transactions going in there. If you pay for a transaction later down the line, maybe you went to PC World and you handed over the wrong card, for example. Well, that then is another director's loan transaction. You're paying for something that you then have paid for using your own funds. Therefore, it's director's loan. So how do we keep an eye on this? Well, here at Boffix, we make it really simple. Let's have a look. We primarily use QuickBooks. QuickBooks is by far our most useful and powerful bookkeeping solution. And this is the one that we've used for most of our clients. Well, when you look on the QuickBooks one, what we set up is down on the right hand side, we will create a director's loan account for our clients. Clicking in there, you'll see the transactions that we've applied against this particular client. We have a running balance, and remember that's crucial because we always need to make sure that the client is in a position where the money is owed to them and it's not a case that they owe the company. So having that running balance can make sure we're on top of it. And we have some transactions in here. So for example, we've got a computer cost. So they've gone to PC or whatever it was, and they paid for it instead of the company paying for it. That's going to be there. We've got some creditors being paid off personally. That's put there. If it's the other way around and it's a debtor being paid off, it's going to be the opposite way around. It's going to be a position where you're basically receiving money. So instead of that money hitting the bank account, it's hit your personal account. So you'd put it against director's loan. Got travel expenses in there. We'll have wages costs going in here as well. So our director's loan account. We have all sorts of transactions going in and out and in and out and in and out. And what it does is it gives us a breakdown. And again, those big transactions like your dividends and your wages, they can get put against there to keep that balance nice and on your side. So every time you interact with your own personal company for personal use, you should be utilizing that director's loan account to move money in and out. Anything that's personally related. If your company pays for something on behalf of you by accident, for example, then it goes against director's loan. So if you accidentally put your Netflix, for example, against the company, and you make the company pay for it by accident, then you just treat that as a director's loan, and that's you taking money out. If you're remunerating yourself or transferring money from your company to your personal account, again, that's director's loan, and you want to move it out. Now, I did say you want to make sure at all times that the director's loan account is in a position where the company owes you, and not that you owe the company. Why? Well, HMRC have some really nasty taxes around it, and it's a tax called Section 455. Now, the numbers Section 455 don't mean too much, and you don't need to worry about the actual number itself, but the premise is really simple. HMRC is under the impression that you've been receiving money from the company without it being taxed. Because if you think about it, if you'd have received the money as a salary, you would have been taxed at source. If you received the money as dividends, you would have to declare that on a tax return and taxed accordingly. If you're in a position though where you've not declared them as either dividends or salary, then HMRC are at a disadvantage here. They've basically not seen that money have any taxes against it. So what HMRC do is if you're overdrawn and your director's loan account is in a position where you owe the company as opposed to the company owes you, then at that point there's going to be additional taxes, and they're really, really nasty. One of the okay things about this tax though is the fact that it's a timing tax. So the idea is that if at year end you haven't paid that director's loan account after 9 months, then you have to suffer the additional tax, and it is quite expensive, 32.5% of the balance that's due. Now, if you do then pay it back at a later date, you are then able to claim that tax back. So it is only ever going to be a cash flow timing issue, but it's something that most people would want to avoid. It's such a nasty tax and such a high rate that really people want to stay away from it as much as possible. There's another thing to note as well. If your director's loan account is above the £10,000 mark, then HMRC will also put an additional tax on there, or want you to declare an additional tax called a benefit in kind. And basically what they're saying here is you've had this interest only loan, and that's unfair. So they want you to start at least putting an interest charge which would be equivalent to what HMRC's base rate would be. And if you don't do that, they're going to charge you an overdrawn director's loan position on a P11D. Again, a really nasty tax you want to avoid. So in summary, what is a director's loan account? Well, a director's loan account is effectively your way of having transactions in and out of your business. What you need to do is you need to be making sure you're keeping an eye on it. Really, real time is the key. So making sure you're using software like QuickBooks so you can see exactly how those transactions are going through. That's why people like Boffix are so popular, because we make sure that that information's at real time. We can see at any point what your director's loan account position is, and we can act accordingly. You need to make sure your director's loan account never goes overdrawn, and especially never goes overdrawn by that £10,000 mark, because both of those can have drastic tax complications that you want to avoid. So many times people are going for a limited company because they want to make sure that their tax position is as strong as possible, that they're in the most tax efficient way they can for running their business. Well, all that can be eroded if you have poor discipline on your director's loan. You make it go overdrawn, you're not keeping on top of it, and then you find out that there is any issues. Most of the time, director's loan accounts can be fixed quite simply by raising dividends, but you've got to make sure you've got the profits in place, and you've got to make sure that that doesn't affect anything else in terms of raising dividends that could cause you additional tax charges down the line. So there's always a fine balancing act between your director's loan account position and what you can do about it. But that's it in a nutshell, director's loan. If you need any more advice on it, don't forget hello@Boffix is your friend, and don't forget the comments below. Let us know yourself. What do you feel is the most tricky part about a director's loan account? Is it keeping it up to date real time, or is it always being able to make sure that you're having to repay it on time? Let me know in the comments below. There's loads of ways in which we can talk about this in more detail. So if there is any more questions you've got, put them down below. We'll do a follow-up video. My name's been Aaron Patrick. As always, it's been an absolute pleasure to do this video for you. Keep yourself locked into this channel. Make sure you like and subscribe, because this is the channel where small businesses just like you are going to get the advice you need, not just to survive, but to thrive. Again, my name's been Aaron Patrick. It's been a pleasure. I will see you in the next video. Bye for now.
Yeah. I told him I can be a fighter if you want. I'll be there to catch you if you fall. I can make it brighter when it's dark, I told him I would do it all for you, and I know you do it for me too. I can be a fighter if you want. I can be a fighter. I can be a fighter if you want. I can be a fighter. That it's real, cause I can get him out of my head. I don't care what we do, everything's feeling new. Even if we stay in bed, my heart is saying yeah. You know I want him nah. My heart is saying yeah.
Hello and thank you for watching that video. What you may not know is this channel that you've watched this video from is part of a wider group. That wider group is called Apple Core Production, and the 3 channels that we have involved are as follows: Aaron Patrick, the QuickBooks Chat, Boffix Tax Tip. Finally, we have Apple Core Live and Geeky. All the links and everything are down below in the description, but it really means a lot to us if you can go and give a like to the other channels as well.